What's going on, everyone? Shiraz Ahmed here, and today we're going to discuss the Canadian real estate market. Now, I'm going to give you a bit of an update based on some recent data points. With the Bank of Canada's interest rate decision and ongoing inflation concerns, there's a lot to unpack here, so let's dive right in. Okay, welcome back, everyone. Now, it's kind of a sad state of affairs when real estate and inflation are trending topics dominating dinner conversations across the country. Or I don't know, maybe I'm just old and boring, but that's all that I'm hearing. Now, jokes aside, there have been some interesting developments in recent weeks, so let's dive into some of them. First, let's talk about the Bank of Canada's decision to hold its key interest rate steady at 4.5%. Now, this decision followed a series of aggressive rate hikes, with the bank raising rates 8 times between March of 2022 and February of 2023. Now, the central bank has signaled that it intends to pause on the rate hikes while it assesses the impact that these increases have had actually on the economy. But now, why did the Bank of Canada decide to raise rates in the first place? Well, the answer lies in the country's soaring inflation, which has reached its highest level in decades. Now, in June of 2022, Canada's inflation rate peaked at more than 8%. However, there have been recent data that shows that inflation's been cooling down, with the rate dropping to 4.3% as of March of 2023. Now, with this cooling trend in mind, the Bank of Canada has actually opted to take a step back for now, and its latest monetary policy report, the bank forecasts that its official inflation rate will actually come down to 3% by the middle of this year and reach its 2% target rate by the end of next year, or 2024. Now, the Bank of Canada governor has assured Canadians that the bank remains committed to restoring price stability, stating that that's the destination, we're on our way, and we will stay the course. Now, while it's tempting for some of us to breathe a sigh of relief with the prospect of a pause in rate hikes, experts like Brett House of the Columbia Business School warn against getting too comfortable. Now, according to House, the central bank is unlikely to be in a hurry to cut rates while inflation is still above its target. And there are strong pressures from the real side of the economy. One of the significant concerns arising from these rate hikes is really the impact on mortgage holders. Now, a recent CBC article discussed homeowners like Eddie Coe, who bought a condo in downtown Toronto 5 years ago and is feeling the pressure. Now, as mortgage rates increase, Coe and his wife face the prospect of a monthly payment that is up $800 or more than what they've been paying. Now, this has forced many Canadian families to cut back on expenses and focus on the necessities, living paycheck to paycheck, unfortunately. Now, the 2% inflation target set by the Bank of Canada is an interesting point of discussion. Now, this target was established back in the 90s by many leading central banks, including the Bank of Canada. Now, it's important to note that some experts argue that a slightly higher inflation rate, let's say 3 to 4%, could be sufficient to prevent runaway inflation, referencing an example from former U.S. Federal Reserve Chair Paul Volcker's tenure. Now, economists like Lawrence Ball and Oliver Blanchard have recently called for a target range of 3 to 4% inflation, which would provide central banks with more flexibility in their monetary policy. However, the Bank of Canada remains steadfast in its commitment to that 2% target, even though it means that a prolonged, frankly, hardship for mortgage holders in this country, and higher unemployment and slowdown in new home construction, and this is causing this housing crisis that we're in right now. Now, in addition to the challenges faced by homeowners, persistent high interest rates may also be part of the problem and inhibiting the progress in addressing these housing concerns. Now, new home construction is currently at its slowest pace since July of 2020, with the Canadian monthly average sitting at 222,600 new housing units this spring. Now, the slowdown suggests that higher borrowing costs may be influencing developers' decisions to start new projects. So to summarize, the Canadian real estate market is really navigating some challenging times, and it contends with really high interest rates and an ongoing housing crisis. While the Bank of Canada's decision to pause interest rate hikes offers frankly, a brief reprieve for homeowners, potential buyers, and developers, but everyone really must brace for the possibility that relief from high interest rates might be at least a year or so away. Now, in the meantime, Market participants and observers really should keep a close eye on the evolving economic landscape, as well as the Bank of Canada's response to inflation and its commitment to that 2% target. Now, it's important for everyone really to stay informed and prepared, as Canadians, frankly, will be able to better navigate the uncertainties and challenges that lie ahead for all of us in this real estate market. Now, I hope you found this information at least insightful or hopefully helpful. If you like this video and you appreciate the content that I'm creating, please consider giving it a thumbs up and hitting that like and subscribe button. Now, if you hit the bell icon, you'll be notified the next time I upload a video. I'm going to also put my contact information at the end of this video. If you have any topic suggestions or anything that you want me to cover, please feel free to drop me a line, and especially if you have any individual questions of your own. Until next time, please stay safe out there, you all. Bye for now.